The formula for interest coverage ratio is profit before interest and income tax divided by fixed income charges. Long-term debt is 6 lakh divided by shareholders fund, that is 3 lakh. So it will be 2 divided by 1, that is 2:1. Debt to capital employed ratio, your formula is long-term debt divided by capital employed or long-term debt divided by net assets. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram PU College, the Temple of Excellence, Mysuru. My dear students, today we are in the 4th session of your 5th chapter, that is from part B, Accounting Ratios. So already we have discussed few types of ratio. So let us quickly recall what we have discussed in a previous session. So in a previous session, we have solved about this solvency ratio where we have learnt about debt equity ratio, capital employed ratio as well as proprietary ratio. In today's session also, we shall continue with few more problems relating to solvency ratio. So go through the problem here. Following information given by a company from its books of accounts as on 31st March 2018, calculate debt equity ratio. So what is the formula of debt equity ratio? Long-term debt divided by shareholders fund. Next, they have asked interest coverage ratio. So the formula for interest coverage ratio is profit before interest and income tax divided by fixed income charges. Next is debt to capital employed ratio. So your formula is long-term debt divided by capital employed. Now they have given us certain informations like inventory 1 lakh, then total current assets 1,60,000, shareholders fund 4 lakh, 13% debentures 3 lakh, current liabilities 1 lakh, net profit before tax they have given 3,51,000, cost of revenue from operations 5 lakh, total assets 8 lakh. So this is the information which is given by a company. So we have to calculate these three ratios, that is debt equity ratio, interest coverage ratio as well as debt to capital employed ratio. So let us solve this problem. So first we shall begin with debt equity ratio. So you know the formula. Your formula is debt divided by equity or long-term debt divided by shareholders fund. Now let us see what is a long-term debt. So long-term debt is equal to, now let us see the information. Long-term debt, they have given 13% debentures. So 13% debentures is your long-term debt, that is rupees 3 lakh. So long-term debt is rupees 3 lakh. So that is your 13% debentures. Next we have shareholders fund. So shareholders fund is equal to, so and this information whether we have shareholders fund, yes we have, that is rupees 4 lakh. Shareholders fund they have given us directly, that is 4 lakh. So we can apply here, shareholders fund has given directly rupees 4 lakh. Now we can apply the formula debt equity ratio. Debt equity ratio is equal to, so rupees long-term debt, rupees 3 lakh divided by rupees 4 lakh. So that is equal to 0.75 divided by 1, that is equal to 0.75:1. So hope you are clear about this debt equity ratio. Now moving on to the next type of ratio, that is interest coverage ratio, where your formula is interest coverage ratio is equal to profit before charging interest and income tax divided by fixed income charges. Now they have directly given us profit before tax. So we have to calculate what is the interest so that we can get profit before interest as well as tax. Okay, so let us calculate the interest first. So fixed interest charges. Fixed interest charges is equal to, so here interest is calculated on debentures. So if you see here 13% debentures, that is 3 lakh. So your interest is 3 lakh It is rupees 3 lakh into 13%. 13 divided by 100. So, when you calculate 3 lakh into 13%, so 3 lakh into 13%, so you will get rupees 39,000. So, this will be the interest. Now, you have to charge this profit before charging interest and income tax. So, profit before charging interest and income tax is equal to, so they have given profit before tax. So, profit before tax is 3,51,000. So, profit before tax plus interest. So, interest already we have calculated. So, profit before tax is 3,51,000. 3,51,000 plus your interest is rupees 39,000. So, 3,90,000. So, 3,90,000 is profit before charging interest and tax. Now, so you have to apply the formula. Profit before charging interest and income tax is 3,90,000 divided by fixed interest charges. Already we have calculated 39,000. So, 3,90,000 divided by 13,000, that is 10 divided by 1, that is equal to 10:1. So, 10:1 will be your answer. So, that is interest coverage ratio. So, your interest coverage ratio formula is profit before charging interest and income tax divided by fixed interest charges. So, we know profit before tax. So, we want profit before interest and tax. So, how to calculate profit before tax plus interest? So, then you will get profit before interest and tax. So, that is 3,51,000 plus 39,000. So, we'll get 3,90,000. So, why we are adding? Because, so normally we will calculate profit after tax. So, we want before tax. So, we will add here. So, normally interest and tax will be deducted from profit. But here if you add, you will get profit before interest and income tax, that is 3,90,000. We know fixed interest charges. It is calculated on debentures. So, debenture value was 3 lakh into 13%. So, you will get 39,000. Now, we will apply the formula 3,90,000 divided by 13,000. So, that is 10 divided by 1, that is 10:1 or 10 times. Now, coming to the next type of ratio, debt to capital employed ratio, your formula is long-term debt divided by capital employed. Now, let us first see long-term debt. Long-term debt is equal to, already we have calculated long-term debt in your first ratio. So, long-term debt is equal to 3 lakh, rupees 3 lakh divided by capital employed. So, let us calculate capital employed. So, your formula for capital employed is equal to shareholders fund plus long-term debt. Shareholders fund plus long-term debt. Now, how much is shareholders fund? That is 4 lakh plus long-term debt 3 lakh. So, rupees 4 lakh plus rupees 3 lakh. So, that is equal to rupees 7 lakh. Now, you can apply the formula, that is debt to capital employed. Debt to capital employed is equal to long-term debt. Long-term debt is rupees 3 lakh divided by capital employed is rupees 7 lakh. It is equal to 0.43 divided by 1, that is equal to 0.43:1. So, this will be debt to capital employed ratio. So, hope you are clear about it. Based on the question, you have to apply the formula and calculate. Now moving on to the next problem. From the following information, calculate debt equity ratio. So your formula is long-term debt divided by shareholders fund. Debt to capital employed ratio. So your formula is long-term debt divided by capital employed. Total assets to debt ratio. So your formula is total assets divided by long-term debt. So they have given only this much information. Based on this, we have to calculate all these ratios. So they have given total assets 15 lakh, current liability 6 lakh and total debt 12 lakh. Now first we shall calculate debt equity ratio. As I told you, your formula is long-term debt divided by shareholders fund or net worth. Now long-term debt. So if you see this information, we can't directly apply the formula. So you have to use the formula and calculate long-term debt. So long-term debt is equal to total debt minus current liability. So what is total debt? 12 lakh minus current liability, that is 6 lakh. So you will get 6 lakh as what? Long-term debt. The shareholders fund. So based on the information what they have given, so upon that we have to write the formula total assets minus total debts. So how much is total assets? 15 lakh minus total debt 12 lakh. So that would be 3 lakh. Now you can apply the formula debt equity ratio is equal to long-term debt is 6 lakh divided by shareholders fund, that is 3 lakh. So it will be 2 divided by 1, that is 2:1. So hope you are clear about debt equity ratio. Coming to the next one, debt to capital employed ratio. Your formula is long-term debt divided by capital employed or long-term debt divided by net assets. Now long-term debt already we have calculated, that is 6 lakh. Now capital employed, your formula is shareholders fund plus long-term debt. So shareholders fund is how much? 3 lakh plus long-term debt 6 lakh. So that would be 9 lakh. Now you can apply the formula debt to capital employed ratio is equal to 6 lakh divided by 9 lakh. So it will be 0.67:1, that is 0.67 divided by 1, that is 0.67:1. Now coming to the next ratio, total assets to debt ratio. The formula is total assets divided by long-term debt. Already we know long-term debt because we have already calculated 6 lakh and total assets they have given in the problem. So total assets is how much? Total assets is 15 lakh. So you can apply the formula directly. So total assets is 15 lakh divided by long-term debt 6 lakh. It will be 2.5 divided by 1, that is 2.5:1. So hope you are clear about the solvency ratio where we have learnt about debt equity ratio, capital employed ratio, total assets to debt ratio, interest coverage ratio. So all these ratio comes under solvency ratio. So in my next session, we shall discuss about activity or turnover ratio. So this is also a very important question for 12 marks where you are going to learn about activity or turnover ratio. We shall discuss in the next class. So my dear students, hope you have understood today's problem. See you all in my next session. Till then, take care. Thank you.